Welcome to Graceful Retirement, where calm financial habits nurture your future. Today we explore how dividend stocks can support gentle retirement growth. In a world of fast trades and high risk, we choose patience and wise selection. Dividend stocks mean shares of companies that share profits with owners regularly. They offer two advantages: growth potential and frequent income. Imagine a small tree that bears fruit each season rather than one dramatic bloom. This habit aligns well with a peaceful mindset, not constant chasing. Our goal is clear: steady growth, regular income, and minimal stress. Let's begin by understanding what dividends are and why they matter. A dividend is a portion of a company's profit paid to shareholders. When a company earns reliable profits, it can share those profits with you. This creates a stream of income, even while you retain ownership of the stock. Over time, these dividend payments can add up and support your lifestyle. Another benefit is that dividend-paying companies often have stronger financials. Such companies tend to be stable, able to sustain payouts through ups and downs. That stability matters when you seek peaceful growth, not dramatic swings. Let's consider a familiar example: a reliable utility company. A utility may have fewer headlines but consistent demand and steady earnings. By owning shares of such a company, you may receive regular dividend checks. These checks then become part of your income flow, quietly supporting your goals. Now, how do you select good dividend stocks with confidence and calm? First, focus on companies with a history of paying dividends for many years. Longevity of payouts suggests the business has weathered cycles and maintained strength. Second, look for a dividend yield that is reasonable, not overly high. An extremely high yield might signal risk rather than reward. Third, consider the payout ratio, that is how much of profit pays out as dividends. A moderate payout ratio suggests sustainability and less risk of cutbacks. Fourth, ensure the company has manageable debt and strong earnings growth. High debt can threaten future payouts when economic headwinds arrive. Fifth, diversify your dividend stocks across sectors to reduce risk. Don't rely on only one industry. Economic changes affect different sectors differently. By diversifying, you smooth out fluctuations and protect your income stream. Now let's reflect on how this fits into your retirement lifestyle. If dividend income becomes part of your monthly or quarterly rhythm, you feel more secure. You don't have to watch markets every minute, your plan is quietly working. This aligns with the gentle garden metaphor: you plant, you nurture, you harvest. Another metaphor: think of your portfolio like a slow river flowing steadily. It may not rush, but over time it moves mountains and nourishes the land. Now, we address a common question: are dividend stocks risk-free? No investment is without risk, but dividend stocks can tilt the odds in your favor. The key is quality selection, patience, and a mindset tuned to consistency. For example, a company that cuts its dividend may send a worrying signal. That might mean earnings fell or debt rose, so selection filters are important. Another risk: concentrating too much in one company or one sector. If that business stumbles, your income could shrink unexpectedly. Therefore, diversification remains a pillar of steady dividend strategy. Another point: keep realistic expectations. This is not about explosive growth. It is about gentle growth, regular payouts, and peace of mind. If you expect wild returns, you may be disappointed and uneasy. But if you accept steady progress, you will likely feel more confident and calm. Let's now connect it to your broader retirement plan. Dividend stocks complement safer assets like bonds and cash reserves. They add a measure of growth and income without reckless risk-taking. In your retirement income mix, think of dividend stocks as one pillar among many. You might hold some bonds, some cash, maybe some real estate and dividend stocks too. This layered approach builds resilience and supports your lifestyle with grace. Another practical habit: reinvest dividends in early years, then shift to income in later years. Reinvesting helps compound growth quietly over time. When you transition to distribution phase, the dividend checks themselves can support spending. By using the same stocks, you reduce turnover, tax cost and stress. Let's also talk about tax and cost considerations in a gentle way. When dividends are qualified, they may be taxed at lower rates. Check with an advisor. Keep transaction costs low and avoid switching stocks too often. Frequent trading often reduces your net return and distracts your focus. Next, monitor your dividend portfolio annually, not daily. A calm annual review is sufficient in most cases, unless something major changes. Check company fundamentals, dividend health, sector balance, and your income progress. If everything remains intact, you stay the course with confidence. If you notice a red flag, you may choose to trim or replace a holding gently. This ensures you maintain stability rather than reacting to every headline. Now let's consider recent trends as of this year that support this strategy. Interest rates remain elevated compared to earlier years, making bond yields more competitive. However, some bonds have risks such as inflation sensitivity or credit risk. In this environment, dividend stocks from strong companies provide an alternative path to income and growth. Also, corporate earnings in sectors such as consumer staples and utilities have shown resilience in recent quarters. These trends support selecting dividend stocks from well-managed companies. Finally, technological change and global shifts continue to create opportunities even for dividend investors. For example, some established firms in fintech or green energy now pay dividends while growing steadily. By combining tradition, dividends, with innovation, new business models, you stay modern without chasing hype. Now we move into the last section, your action steps for the week. Step 1. Choose one dividend-paying company you understand and check its dividend history. Step 2. Review its payout ratio, debt levels, and sector diversification within your portfolio. Step 3. Decide whether to include it in your portfolio and whether you will reinvest or use the income. Step 4. Note that you should spread your investments across at least 3 sectors. Step 5. Mark on your calendar an annual review date for your dividend holdings. By doing these steps, you establish habits rather than one-time actions. Habits are the root of a graceful retirement, not just good intentions. Let's summarize the key takeaways from today's session. We explored what dividend stocks are, why they matter, and how to select them wisely. We discussed how they fit into your retirement plan alongside bonds, cash, and other assets. We emphasized patience, quality selection, diversification, and habit formation. We reminded ourselves that steady income from dividends supports peace of mind, not stress. Now, let me share a closing thought with a proverb: a stitch in time saves 9. This means taking small preparation steps today prevents bigger problems later on in your plan. If you notice a small warning sign in a company's dividend, act gently but promptly rather than waiting. By doing that, you maintain your calm, preserving your growth and income over decades. And as another proverb says, slow and steady wins the race. When you invest for dividends responsibly, you may not sprint, but you will arrive with confidence. In retirement, arriving is more important than arriving fast with anxiety. Thank you for joining Graceful Retirement today, where every habit matters. I look forward to supporting your journey towards steady growth, regular income, and peaceful freedom. May your dividend stocks become one of the pillars of your graceful financial life. Thank you, and until next time, may your retirement be calm, confident, and well nurtured.